Welcome to Mad Money. Welcome to Cramer. Other people, friends, I'm just trying to help you make a little bit of money. My job is not just entertaining, but I'm trying to teach you a little bit here. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. You know what's fueling this market? It's the skeptics. That's what. I think the professional money managers are concerned about how far the markets run and the consistent gains we're experiencing, including today, where the Dow gained 239 points, S&P advanced 0.01%, and NASDAQ dipped 0.28%. But the amateurs, the home gamers drawn to individual stocks now, keep powering this strong move higher. And as we get closer to the end of the year, the pros start to throw in the towel and do some buying just to prove to their shareholders that they didn't miss out on the market's biggest winners. Those investors want to make some money, too. I think that's what's happening right now. Could be early, but it does feel like there is a lot of fear of missing out, doesn't there? Today, nearly everything went higher, including crypto, gold. Pretty much every asset class that the professionals see is overvalued. It's very easy to denigrate this market if you're a pro. That's because the pros see bubbles everywhere. Data centers, uranium from nuclear reactors, the power, of course, of data centers, and quantum computing, which really burst higher today in spectacular fashion. I mean, those stocks have just gone ballistic. The professionals want to see this speculative stuff cool down, including the data center stocks. They want those lower, too. They see these stocks as pathetically overvalued, but they can't force them to go lower, and they're afraid to short them. It's like a fait accompli. I think we're benefiting from a window that happens right about now on the calendar, with no earnings of any consequence in sight, and lots of momentum coming from individual investors again, who are drawn to the companies that help them trade. I mean, just look at Robinhood, a Coinbase leading the charge. Now, with that in mind, what's the game plan for next week? Well, first, the president's been real quiet about stocks lately since the deal with Pfizer. It makes it look like the drug companies won't get hurt too badly by the president's plan to roll back drug prices. The gains in big pharma have been outstanding, and they continue today. I'd like to see a deal with at least one more drug company after this rally. So far, we haven't gotten another one, but look for that to happen next week. I get antsy when the president says nothing about business because that usually doesn't last for more than a couple of days. Monday, Constellation Brands, STZ, reports the company has fallen out of grace along with the rest of the alcohol plays. CEO Bill Newland's acknowledging on the last earnings call that the company is being impacted by ICE raids in popular shopping destinations. The decline in volumes has matched the decline in the stock. Constellation has been trying to bounce of late. At 12 times earnings, it's the cheapest I've ever seen it. But the multiple contraction seems justified given the company's recent track record, as well as the rise of GLP-1s, which reduced craving for everything, including alcohol. Tuesday, we have our monthly meeting for the CNBC Investing Club with a very special guest. More about that on Monday. Then we get results from the always reliable McCormick. Problem is, though, reliability hasn't been enough to move the needle for this stock. The spice maker still has a premium multiple at a time when the packaged food group has fallen totally out of favor in this market. Let's put it this way. If any food company can do well in a slowdown, it's McCormick, because spices are excellent trade-down material. The stock's down nearly 10% for the year and well off its highs, so it has a fair chance to bounce, but I just don't trust the whole group. Earlier this week, Conagra reported it bounced a tad on an inline number, so there's some hope. But food's now a tough business. It's too hard for me. Now, Dell, this one isn't hard. They hold an analyst meeting on Tuesday, and I think it's going to be terrific. This company has been the leader in working with NVIDIA to integrate artificial intelligence. When I sat down with Michael Dell earlier this year, I was blown away by how much business he's doing in the space. Michael and his family office bought a huge amount of stock when Dell got clobbered earlier this year. It was a brilliant move. I think his analyst meeting will be the highlight of the week when it comes to things that can move stocks. Runner-up, though, will be what looks like a sleeper right now, Solstice, the Solstice analyst meeting. Solstice is Honeywell's advanced materials spinoff, which is now getting zero credit. Not the breakup that Honeywell's having will end up giving you a pure play aerospace company, which this market craves, as well as a building automation company that has some of the best technology and yet is unheralded. And the Solstice is happening earlier. Now, I don't want to get ahead of myself, as the materials company might be an undiscovered gem, but Honeywell's making a pretty bold move here. You know, it's breaking up what former CEO Dave Cote put together when he was running the company. Now, I praise Dave in my new book, How to Make Money in Any Market, for his acumen at turning divisions around and constantly shuffling the portfolio to upgrade performance. I believe he'd be very happy, though, with this breakup by Vimal Kapur, the current CEO, although right now it's in limbo. because the big breakup between automation and aerospace is very far away, and no one wants to take a leap of faith. They won't get in now for what's going to happen more than a year from now. Now, we've gotten a couple of important earnings reports on Thursday, including PepsiCo and Delta in the morning. Now, recently, Elliott Management, a hard-charging and thoughtful activist fund, took a big stake in PepsiCo. They want changes. Will management go with Elliott, or is it going to fight Elliott? We'll probably find out when Pep reports. It's been a very tough time for shareholders of PepsiCo, but the stock now does yield 4%, and it has a very solid snack franchise in Frito-Lay. My concern, as usual, is with a younger generation that cares more about their health than their parents, and with the GLP-1 weight loss drugs that cut back craving, including cravings for Frito-Lay's big business, which is potato chips. I think CEO Raymond LaGuardia hasn't been able to deliver of late, with the stock down almost 7% for the year, while Coca-Cola is up 7%. Comparisons are odious, unless they're in the stock business. Delta's a tough stock to own. It's been among the best performers in the group, yet it's still down 5% for the year. I know the consumer is supposed to be weaker, but there's still an appetite for travel. I think it might work as a trade. But like I say in my book, these are the toughest stocks to own. So many things can go wrong. After the close, Levi Strauss reports, and this company's become very reliable despite tariffs. It hit a 52-week high today. That last quarter was extraordinary. I think another good one could be coming. Finally, on Friday, Austin Goolsbee talks. Now, why does this matter? It matters because he's a voting member of the Federal Open Market Committee. He spoke this morning on CNBC, our network, about an economy that might be too strong to cut rates. This rally's been built on the idea that more rate cuts are coming. Goolsbee's comments restrained the market in the morning, so look out. Because of the federal furloughs, we didn't get a labor report today. So everyone, including Goolsbee, flying blind. Here's the bottom line. We have a lot of anecdotal evidence of weakness, but not anything hardcore. We need to watch this as we're about to head into earnings season, and the bulls could run into serious trouble if the Fed doesn't take action. For my money, the economy away from the data center build-out is getting weaker. This is no time for indecision. The Fed needs to cut because too much of the economy away from this multi-trillion-dollar build-out just isn't going anywhere. Sam in Massachusetts. Sam.
Jim, first I got to say Yom Tov to those who celebrate. But anyway, my question...
Happy and healthy to you, sir. Okay.
Yes. My question tonight is on a company that many will be familiar for their Clover payment processing business. That's
sure.
Fiserv. The company is trading at $69 billion, and it looks undervalued given the $5.6 billion in quarterly revenue that they just did. Stock's trading at a 40% discount to where it was at the beginning of the year. And so I'm curious what you think about Fiserv based on the continued strength of the consumer despite headwinds with the overall...
Sam, I got to tell you, that was not a good last quarter, and it was shocking. I think you got to wait another quarter, see if you can get it together. That was just not that good a quarter. Nothing I can say about other than that. Let's go to Elaine in California. Elaine.
Hi, Jim.
Elaine, how are you?
Pretty good. Thanks for taking my call. Congratulations on the book. I downloaded it today.
Oh, thank you very much. I'm glad you did that. I hope others do. I like it when people read. What's going on?
I had a question about ticker symbol HIMS. Do you think it's overvalued? Should I get out or should I buy more in the pullback?
It's what I call a football stock. I mean, there's just every day there's a short crushing it or a long bull in it. I think it's a very hard stock to own. So therefore, I say find an easier one. This one is too tough. Let's go to Kevin in California, please. Kevin.
Hey, booyah, Jim from Weed, California. How you doing?
I am doing well. How are you doing?
Real good. I've been watching for many years. First time, long time. How about those Eagles?
Oh, we look good. We find a way to win. Let's hope against the tough Denver defense we do okay.
There you go. Speaking of Eagles, I'm talking about AEO, American Eagle Outfitters. I bought a bunch after Sydney Sweeney commercial debuted, and it took off. Now it seems to be pretty stagnant. Do I buy, sell, or hold? Thanks,
My
Jim.
instinct is to ring the register. Why? Because we had the event occurred, and now we're getting away from the event. And there are a lot of people who say, wait a second, the company isn't doing well away from that. I like to just see you get a bit of a win here, take some off the table. All right, we need to be on the lookout for more signs of economic weakness this week because the bulls could run into some trouble if the Fed doesn't take more action soon. Oh, man, Money tonight. Have you seen this run in SoFi? Soaring over 200% in the last year. I'm taking a closer look at the story to see if it has legs. Then DraftKings has found itself in the doghouse. So I'm covering what's ailing the stock. And if think today's move higher could be a sign of what's to come. Plus, I'm sizing up an under-the-radar rare earth play that you called in about and sharing where I come down on this speculative name. You got to hear it. So stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
We're finally getting a meaningful pullback in one of the hottest stocks of the year, SoFi Technologies. The fintech disruptor has become the digital bank of choice for millions of younger customers. Now, I've been recommending this one for years, even when the stock struggled. I think SoFi's got a great concept. I've always believed in its bankable CEO, Anthony Noto, going way back to the days when he was still an analyst at Goldman Sachs. But from 2022 through 2024, SoFi just couldn't get any traction at all. With the stock stuck in the mid-single digits, every time it started to rally, it would lose its momentum. Even after SoFi made a big move around this time last year, breaking into the mid-teens for the first time in almost 3 years, the stock sputtered earlier this year, dragged down by tariff worries like the rest of the market. By the time we reached the post-Liberation Day washout in early April, SoFi was back in the high single digits. But over the past 6 months, SoFi feels like an idea whose time has come. From the stock's April low of $8.60 to its high of $30 and change set early last week, this darn thing has shot up more than 250%. As of today, it's pulled back to $25 and change, but it's still nearly triple from the April lows. And it's up a quick 57% since we last spoke to the CEO near the end of June. So as a longtime SoFi bull, I feel pretty darn vindicated these days, and I've got to tell you, I think this one's not finished going higher. The first thing you need to understand is that this rally was driven by genuinely great numbers. SoFi's total member count has more than doubled from 5.2 million in 2022 to 11.7 million in the latest quarter, and it's on track to reach nearly 13 million by the end of the year. The revenue has more than doubled, too, from 1.5 billion in 2022 to an expected 3.4 billion this year. But unlike previous rallies, this time I think the moves got legs because SoFi is finally profitable with excellent earnings growth. Last year, SoFi had its first positive earnings result, making 15 cents per share, and that's expected to more than double with 31 cents this year. That's important because while SoFi looks pretty expensive at 81 times this year's earnings estimates, 81 times earnings is actually pretty reasonable for a company with 107% earnings growth. Next year, they're expected to earn 55 cents per share, meaning the stock sells for actually 46 times the 2026 numbers. Okay, still expensive, but not relative to the 77% earnings growth that Wall Street expects from this company next year. It's much easier to stick your neck out for a seemingly expensive stock with phenomenal earnings growth. Hey, by the way, I wouldn't be surprised if SoFi outperforms these earnings estimates. This company has developed a reputation for outperforming the estimates, and lately that outperformance has been particularly strong. SoFi's actually been doing this for a while. Now, I went back and checked, and SoFi's beaten both sales and EBITDA estimates every darn time since it came public in 2021. Can you imagine that? Over the past 7 quarters in particular, SoFi has also reported much better than expected earnings per share. In fact, when the company reported its latest numbers in late July, the quarter, I'm calling it fantastic. Total members and products were both up 34% year over year, both records. Adjusted revenue grew 44% year over year, trouncing the estimates, with a fee revenue of a staggering 72%. That's fantastic. So how the heck has SoFi been able to put up these incredible numbers? Well, the company keeps expanding its banking offerings to the point where it's now more of a full-service financial institution, one that already has won the trust of younger consumers. SoFi wasn't originally just an online lender, a place you could turn to for student loans, personal loans, and later on mortgages. They now offer home equity loans of credit, and auto loan refinancing options too, plus credit cards. In the years before SoFi came public in 2021, it launched a couple rudimentary versions of its bank account and investing platforms, but they've really flourished in the past few years, especially after the company obtained a national banking charter in early 2022. SoFi now offers legitimate bank accounts, checking accounts, and high-yield savings accounts with very competitive interest rates, which are many which are many multiples of what you get from one of the big national banks. Their standard savings account yields 3.8%. Try getting that from JP Morgan or Bank of America. As for SoFi's investing platform, while it's not as popular as Robinhood's, it's still pretty darn good. At this point, they've got self-directed investing, retirement accounts, robo investing, and custom ETFs. SoFi members even have the ability to access select IPOs, which was unthinkable not that long ago. Getting a piece of these deals can be pretty darn lucrative. And after backing away from crypto trading for a bit in order to get that banking charter, SoFi is starting to dip its toes back into that space too. Outside of the core lending, banking, and investing options, SoFi also sells insurance and plenty of other helpful services like credit monitoring, budgeting tools, and even estate planning services. About 3 years ago, SoFi also rolled out a premium membership program called SoFi Plus. Management says that this Plus plan now offers over $1,000 in value via rewards, benefits, and preferred pricing, along with other perks like access to financial planners. And it costs you $10 a month, or nothing if you sign up for direct deposit. That's the real point. SoFi is a real bank now. Millennials and Zoomers get comfortable going to them for some initial products, say a student loan or a $5,000 personal loan to pay off some credit card debt, and then they learn that they can get a checking account and stick around. Once they get a little more money, they can use SoFi's high-yield savings accounts or their investing platform. Maybe they get their mortgage through SoFi later on. But the point is, SoFi is increasingly getting customers for life, and investors finally appreciate the immense scale of the opportunity here. Let me give you the bottom line. I've been recommending SoFi for years because I realized that they had a unique hold on younger people, and over the past 12 months or so, that's really started to pay off. The stock's caught fire, and thanks to its recent sell-off over the past couple of weeks, you're now getting a chance to buy it at a relative discount for the first time in ages. While I'm not expecting SoFi to triple again over the next 6 months, it wouldn't shock me if it can put up a similar performance over the next 3 to 5 years. Mad Money is back after the break.
Coming up, a prediction market parlay. Cramer's cracking open the sports books and looking at where DraftKings stands in the space. Next.
What the heck has gone wrong at DraftKings? I mean, back in August, the online sporting betting company, it reported a great quarter. Even if they didn't raise their full-year forecast, and the stock did initially sell off 5%. Sell. CEO Jason Robbins came on the show. Yeah, I thought he told a great story. And the stock did come back with a vengeance, ultimately climbing to $48 and change at the beginning of September. Oh, but ever since, DraftKings has been just obliterated, with the stock now down almost 28% from its last month peak. It closed at $35.37. You know, the stock is now down almost 5% for the year. What is behind what I regard as pretty much of a breathtaking decline? Okay, I want you to keep in mind that September is a pivotal month for the sportsbooks because it marks the start of the football season. It's make or break for these companies. A year ago, DraftKings struggled during this period because too many people were betting the favorites, and the favorites kept winning. People love to bet the favorites. So the bad news, and by the way, that is bad news for sportbooks. When more favorites win, the sportbooks experience higher losses. More parlays are also likely to hit when the favorites are winning. That also is bad for the house. And this September, NFL favorites won at an even higher rate than last year, at least until last night's surprise victory by the 49ers. This is supposed to be a temporary problem. But if it keeps happening, you got to wonder if maybe the people placing these bets are becoming more astute. At the same time, DraftKings and its compadres are facing more competition from online prediction markets. The prediction markets, especially Polymarket and Kalshi, let you bet on nearly anything. There was a whole South Park episode on it recently. You often hear about people betting on political outcomes, but they cover all sorts of stuff, including like who will win Time Person of the Year for 2025. Right now, AI is frontrunner. I guess no job is safe. More importantly, they're doing sports betting because why not? Instead of traditional odds, bets are quoted based on what you need to put down to win $1. For example, last night's Kalshi line on the 49ers to win was roughly 30 cents, meaning that each share would cost 30 cents to win $1. This is different than how traditional sportbooks operate, but it's ultimately very similar in terms of payout, and it's much easier to understand. Plus, these platforms merely operate peer-to-peer betting markets. They give people a marketplace to bet against each other, rather than taking the opposite side themselves. That they make their money by taking a small transaction fee from each bet or by taking a percentage of the winnings. Long term, they could allow the prediction markets to offer better odds than the online sports books like DraftKings or FanDuel. But the biggest competitive threat here is the lack of regulation. A company like DraftKings is heavily regulated by gaming regulators in the states where it operates, but platforms like Kalshi are treated as designated contract markets by the CFTC, which means they're treated more like a stock exchange than a traditional sports book. Because the prediction markets don't take the other side of the trade, though, they're not actually gambling. It's not gambling, so they don't need to navigate the patchwork of state-by-state licensing laws. While DraftKings is desperately trying to get approval in states like California and Texas, people in those states can already bet on these games via these prediction markets. And though Kalshi had $260 million in trading volumes last Sunday, already surpassing the previous record on Election Day last November. Now, these concerns reached a fever pitch during Monday Night Football. Shortly before the kickoff between the Jets and Dolphins on September 29, Kalshi temporarily rolled out a new feature called Build Your Combo. While that might sound like a new offering from Taco Bell, it's essentially operated as the same game parlay, giving users the ability to combine multiple types of bets into a single contract. What's so dangerous about that? Well, people love these parlays, and they're immensely profitable for companies like DraftKings. So this kind of competition is terrible for them. And that's why the stock plunged 11% on Tuesday, and it's been sinking lower ever since before finally stabilizing today. That said, I think the sellers, frankly, might be overreacting. Compared to DraftKings, the sports betting offerings from the predictions markets they're pretty bare bones. Some analysts have defended DraftKings and asserted that the headline volume numbers we're getting from Kalshi might not be a fair comparison to traditional sports books, even the structural differences in making a market versus operating a peer-to-peer marketplace. Other analysts seem to think that the argument's bogus, though. While these prediction markets can operate in states where sports betting remains illegal, that also makes it hard to tell if they're actually stealing much actual business from DraftKings. According to Jefferies, a quarter of Kalshi's revenue came from Texas and California, where DraftKings doesn't operate. When people have the choice between the two, they tend to go with regulated sportsbook like DraftKings or FanDuel. Meanwhile, analysts at Oppenheimer estimate that roughly 40 to 50% of Kalshi's volumes come from its partnership with Robinhood, which suggests that much of their user base is generally new to sports betting. The analysts think that this could either be even be a tailwind for the sports books down the line, similar to how DraftKings and FanDuel saw user growth tick higher following the launch of ESPN Bet, because it lured more people in, and these people eventually migrated to better platforms. That's not even factoring in the dizzying legal situation that the prediction markets find themselves in. As you might be asking yourself, how is all of this even legal? Well, it turns out many states are asking the same question, with Kalshi involved in a host of lawsuits across several states. They got some bad news just today as a federal judge in Nevada, a judge that Kalshi has a pending case with, ruled sports prediction markets do not qualify as swaps in the case with Crypto.com. That doesn't bode well for Kalshi. Just to throw one more wrinkle into all this, Donald Trump Jr., that is, sits on the boards of Kalshi and Polymarket. So maybe they'll have more luck if they can appeal to the Trump-friendly Supreme Court. I don't know. Look, I don't want to speculate on the outcome here, but you should be aware of the flimsy legality of the prediction market situation before you panic and sell DraftKings down here. After all, there's a reason why the online sportsbooks haven't gotten into prediction markets. They're probably worried that when the regulators finally come down on these platforms, they'll come down hard. If anything, it might spur some states that are holding out to potentially legalize traditional sportsbooks so that they can at least get the tax revenue. If their constituents are already gambling, I mean, really, what's the harm? So where do I come down on this? Despite today's rally, DraftKings is still down almost 5% for the year. It's down a whopping 28% from last month's high. I've spoken with CEO Jason Robbins on multiple occasions and like the direction the company's headed longer term, which means this could be a buying opportunity. So here's the bottom line. I'm not backing away from this stock. I think the predictions market fears are overblown here. So if you don't already own any DraftKings, I'm telling you, you got my blessing right here to put on a small position. Beyond that, let's suspend judgment until they report at the end of the month. Let's go to Gilbert in Illinois, please. Gilbert.
Hi, Jim. Can you give me your thoughts on stock symbol MGM? Is it a hold, buy, or sell?
I'm actually not much of a fan. And that's because, and particularly as of today, you're getting a real chance to buy Wynn at a discount from where it was. The stock is down 9 today, and I think Wynn is a very high-quality company, and it's going to come back. I mean, they're down because of what's known as Golden Week data, which was weak. Probably get some downgrades tomorrow. Buy, and I would take a shot at I would invest in Wynn tomorrow. Let's go to Jerry in Missouri. Jerry.
Hey, Jim. Thanks for taking my call.
Of course.
Jim, because there have been reports of declining daily average users and a significant drop in responses from ChatGPT, this stock was down over 30% from its highs. Today it started to rebound. Do you see this as a reason to run away from Reddit?
Okay, I saw this stuff on Reddit and been trying to get. I mean, a lot of these chatbots rely on Reddit. You often see them as like the first or second indicator. I think that was kind of excessive. The stock has had a remarkable run. I think that the pullback, though, is viable. I think Reddit is a valuable institution. I think the numbers are good. I would put on some here, and then I would wait to see if it drops again, because actually, quite frankly, people look at the chart, and the chart is not so great. Let's go to Dave in Hawaii. Dave.
Aloha, Jimmy Chill.
Mahalo. What's going on, my friend?
Hey, man, just want to say I love you and your team. I bought your book. Coming to my doorstep today, and I can't wait to get it and start reading it. Thank you so much for everything you do.
You're very kind. I've been doing my tour on the book and getting some good feedback, and I appreciate you saying those kind things. Thank you.
Hey, man, let's get to the business. So, look, you've had the CEO on multiple times. Earnings are coming out next month. Jim, hey, look, you guys, you're the cream of the crop. Well, what do you think about Wingstop taking the dip?
Okay, I think this is a really important call because I was surprised that it started going down. I fear Wingstop because they've not been, let's say that they don't really offer the kind of guidance that I want. And let's put it this way. I think it's too high risk, and the restaurant stocks are not doing well. We own Texas Roadhouse for the Travel Trust. As you know, it's not doing that well because of the prices of food. Too many of these commodities have gone up too much, so I'm holding back everything until I see the earnings themselves. All right. Anyway, and thank you for the kind comments about the book. All right. I think the fears around the prediction market impacts on DraftKings, I'm calling them overblown at this point. And you got my blessing to put on a small position here for the pullback. Much more Mad Money. Whenever you call and stump me, I promise to do the homework and then get back to you. Tonight, I'm taking a closer look at a really hard one, a coal play called Ramaco Resources. See if it could be a potential winner under the current administration. You do not want to miss this. Then it's been an exciting time if you own the stock of Apple, but now some naysayers come out of the woodwork. I'm helping you stay focused amid a flurry of conflicting headlines. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. You know me. Every time I get a question about a stock I can't answer, I promise to circle back and then do some homework, give you a more considered answer because you deserve one. A few days ago, I got stumped by Michael in Arizona, who pretty much pitched me on Ramaco Resources, and the symbol here is M as in Mary, ETC, a coal producer with a possible rare earth elements kicker. Now, Ramaco specifically makes metallurgical coal. That's the kind that's traditionally used to make steel. But modern technology uses significantly less coal these days, as Nucor Cleveland-Cliffs will gladly tell you. So ordinarily, I'd be pretty skeptical of this company, even with a very pro-coal administration in the White House. But Ramaco's not just a coal play anymore. That's why the stock's up almost 500% from its April lows, setting a fresh all-time high just today. The company's getting into rare earths in a major way at a time when America's desperate for these materials because most of the world's current capacity belongs to China, giving them a stranglehold on all sorts of important industries. A few years ago, Ramaco acquired a mine in Wyoming. About a year later, they started talking about the rare earth elements part of the story. And they did it much more enthusiastically, saying this mine contained what could be, quote, the largest unconventional deposit of rare earth elements, end quote, in the United States. After all of that activity in mid-2023, Ramaco put on a major rally and into the end of the year with its stock basically tripling at the time. But then, for whatever reason, it rolled over, essentially gave up all of its gains. The core coal metallurgical business, that continues to be weak. Investors probably realized that the rare earth story was well in the future, and enthusiasm about electric vehicles, one of the big end markets for rare earth, well, let's just say, that faded as well. Until the president launched his latest trade war with China, there was very little appetite for domestically produced rare earth minerals. Wall Street figured we'd just keep buying this stuff from the Chinese, so Ramaco's shares went right back down. Now, though, domestically sourced rare earths have become a much higher priority ever since it became clear that our dependence on Chinese rare earths was a major vulnerability. Particularly, a lot of stuff's used for defense. While there was plenty of talk about rare earths from the company in the spring, this angle of the story started to work its way into the stock's performance in early July, after the company published promising results from a third-party study of their key rare earth mine. In other words, they didn't use the study, make the study, a third party did. After that, things began moving very quickly. There was a ceremony at the Brook Mine to celebrate its opening. This is the first new rare earth mine in the United States in more than 70 years, as well as the first new coal mine in Wyoming in over 50 years. On top of that, Ramaco raised $57 million in new debt funding in late July. Then it raised another $200 million in August through an underwritten secondary offering, common stock. Around that same time, the company had its second quarter report, and though the actual numbers weren't anything to write home about, all the talk was about the rare earths opportunity. Then last month, Ramaco announced an expansion of the Brook Mine project, telling shareholders that the, quote, various arms of the administration, end quote, had asked them to put pedal to the metal because this is a critical mineral project. They're now doing everything in their power to upsize the mine's production. Finally, over the last couple of weeks, a number of analysts have written about Ramaco, with one analyst from Jefferies, who already covered the company, raising their price target substantially from $27 to $45. Two other analysts from boutique research firms coverage on the name, both with buy ratings. So that's why Ramaco Resources has seen its stock roar higher. The question now is whether or not it's worth chasing this thing after such a spectacular rally. I got to say, I wish I had found it earlier, of course. At this point, though, I don't feel comfortable recommending the stock after such an extreme parabolic move. I don't like parabolas. It would be one thing if Ramaco had a decent core business that could provide steady profits and cash flow, while the growth projects in rare earths gradually ramped up. But if you look at the numbers over the last couple of years, the core coal business is really bad. If the rare earths mine in Wyoming, that's now the crux of the story, was more mature and further along, that might make me feel better. But as encouraging as the studies of the mine have been, it's still extremely early days for that project. They only broke ground 3 months ago, and the expansion of that mine was just announced last month. The last thing that gives me pause here is the company's dual-class share structure, which is confusing, as is its inconsistent dividend strategy, which removes an element of safety that we'd have if it says, let's say a company paid a regular cash dividend that worked out to a nice, strong dividend yield. A couple years ago, Ramaco rolled out a tracking stock, METCB, where the performance is tied to specific assets like royalties from coal mines and future rare earth mines. The tracking stock pays a dividend, sometimes in cash, sometimes in shares. Look, the whole thing is incredibly difficult to fathom. But there's one big caveat here that makes me hesitate to go negative on Ramaco Resources even after this run. This company feels like the kind of company that the Trump administration might be willing to take a stake in. Remember, they did this with MP Materials, the only other major domestic rare earth play. And most recently, they did the same thing with domestic lithium producer. Every time one of these U.S. government stakes has been announced, stock in question skyrockets. Buy. And given that the government proactively asked Ramaco to expand its rare earth project in Wyoming, I'd say it's certainly a possibility here. If that were to happen, it'll go up even more. Major pop. So here's the bottom line. I'm not going to recommend Ramaco right now because I feel like we missed the move. The core business still appears troubled. The growth business is far in the future, and the corporate structure is confusing. But if CEO Randall Atkins wants to come on the show and give us the pitch directly and clear up some of these points of confusion, he now has an open invitation to do so. Mad Money will be back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It's time for the lightning round. There's that draft cost the same as stock said about my buy, so just another talk with my stock that have been playing. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Let's start with Beth in California. Beth.
Hey, Jim. Thanks for taking my call. I'm a big fan of your show, and I've learned so much from you. I ordered your book from Amazon, and I'm really looking forward to learning how to make money in any market.
Thank you.
So I wanted to ask about AMBQ.
Oh, Ambic Micro. Look, we got to be careful that there are so many good semiconductor companies out there. I'd rather see you in Broadcom, ABGO. I think that's obviously, it's not as speculative as Ambic, but I like it because it's really got a lot of new business. Let's go to Joe in New Jersey. Joe.
Hello, Mr. Cramer. I missed your book signing on Tuesday, but I'll be at the Great Hall in November to see it.
All right, that's what matters. What's going on?
Yeah, I'm a longtime holder of Albertsons, and with the merger not going through and Amazon launching Amazon Grocery, should I still hold on to it?
I don't like Albertsons here because exactly what you just said. I think that's the worry. I do like Kroger, but it's come down just so badly, and we've been buying, is Costco. I mean, it's almost as if Costco's not a good company, and it's a very good company. That's the one I prefer you to be in. Let's go to Ralph in New York. Ralph.
Booyah to the one, the only, and the priceless Jimmy Cramer.
Well,
Long-time fan of yours, and you're here.
Thank you very much.
And if I may, a quick shout-out to the New York Yankees who played a game for the ages last night.
Very true.
I am asking, do I buy, take some profits, or hold regarding a company that just had some clinical data showing significant slowing of Huntington's disease progression in patients treated with its gene therapy candidate? The company is Unicure.
Yeah, I saw that news, and it was really terrific. But I also saw that Insider sold about $9 million worth of stock after the run. I think it's a parabola, and after a parabolic move, I will not endorse it. Even if I think it's good, I have to stay away. This one has too many questions for me up here. Let's go to Brett in California. Brett.
Jim, thanks for staying healthy for us. I have a quick question for you.
Sure.
Chevron, do you still believe in Mike Worth? Can I own it and not trade it?
Yeah, no, I spoke to Mike today about the fire. I'm not really worried about that at all. I think you can own this 4.5% yield. Now, I'm not a big fan of oil. I think you can go below 60, so be ready if it does do that. Remember, this stock had been at one point just not that long ago down to 135, and so it's at 153. I think you buy some and then you wait to see if it breaks down because of that $60 possible breakdown. Let's go to Kathy in Arizona. Kathy.
Hey, Jim. I'm wishing you luck on your upcoming book tour. Looks fantastic.
Thank you. Thank you.
You're welcome. I'm looking at a slightly out of favor stock with a decent dividend and below market PE that may be able to take advantage of decreasing interest rates and NVIDIA millionaires. Should I take LCI Industries for a recreational ride?
It has not done as well as Thor, and yet it's in a similar business. I like your thinking. I think you'd be a beneficiary of lower interest rates. I think that you can buy that stock. If Thor's up this strongly, I think that they can catch up. Let's go to Logan in Oklahoma. Logan.
Booyah, Jim, from the great state of Oklahoma. How are you this evening?
Fantastic. How are you doing?
I am sarcastic, bombastic, and feeling fantastic, my friend.
There you go. I like that. It's a good sentiment. How can I help you?
Jim, I've held Dillard's since November of 2021, and it's one of the largest positions I have, and I'm curious to get your take on that stock.
Well, first of all, I think that Dillard, having shopped there, but not that recently, I say, wow, at 42%, that's a lot. Let's do this. Let's take some of it off the table and let the rest run, okay? Because the numbers aren't that great and the multiple's really high. I like Costco much better. Sell some of that, buy Costco. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, Cramer's doubling down on his own it, don't trade it mantra when it comes to Apple. Don't miss his take on the stock. Next.
It's an exciting time to be an Apple shareholder, isn't it? The stock's been roaring thanks to the strength of the new iPhone models. It's almost about to take out its high, we hope. The new phones truly are remarkable. I mean, you got this iPhone Air, which feels as light as a candy bar in your hand. You got the regular form factors with a fabulous camera, terrific battery life, and the phones have this AI-powered selfie feature. Hey, it's amazing. somehow it figures out how to fit everyone in the picture. No more half faces, half bodies. Isn't that terrific? But not everyone's pleased. Today, we got a report from a fellow by the name of Edison Lee at Jefferies, who even as he raised his iPhone 17 unit growth forecast, is cautious because of concerns about the next iteration, the iPhone 18. He worries that, and I quote, current valuation prices in overly bullish iPhone outlook, end quote. So what does he do? Well, what you do when you're worried, you downgrade Apple. And this time he took it from a hold to a sell. The call embodies everything that's right with sell-side research, but also everything that's wrong with sell-side research. First, let me see it. Edison has nailed every move in Apple stock. On January 20th, Apple near a high, he took it from a hold to a sell. On April 9th, with the stock this time at $172, he upgraded it from sell to a hold. Incredible post-Liberation Day timing. On May 2nd, if the stock had a nice run to 213, he took it from a hold to a sell. Then on July 1st, with the stock at 208, he went from a sell to a hold. And today, after a huge run to 257, he cut it back to a sell. Now, if you run a hedge fund, every one of these calls has been spot on, dead right, fantastic even. Back in the day, I would have killed for these calls. If I found an analyst this reliable, I would have treated his words as gospel. Because, again, for a hedge fund, this stuff is priceless. But for you, not so much. It's just the individual investor just can't do it because all these pivots are overwhelming. I'd wager that there's almost no way home gamers can profit from the strategy, especially after taxes, because it's simply too hard to execute well if you don't have your own trading desk. Well, I wish you could, but you don't. That's why I say own Apple, don't trade it. The whole genesis of my view, as I explain in my new book, How to Make Money in Any Market, has to do precisely with this kind of excessive trading. How much better would an individual have done if she just decided that Apple was a terrific company? So she owned the stock and didn't flit in and out of it because flitting's too difficult. Sure, Edison Lee can do it, but then again, he's never had a buy rating on the stock during this whole period. So if you listen to him, maybe you never even owned Apple in the first place. I think that if you agree with me about owning it, not trading it, you will enjoy, by the way, How to Make Money in Any Market, because I spent a tremendous amount of time really criticizing trading as a tactic. It's not a trading book. Why is that? Because non-professionals, it's just too hard. It's much better to find the stocks of companies you love, and if they go down, you buy more of them, which would have been the best strategy, after all, for owning Apple. In my book, I praise sticking with Apple stocks, individual stocks like Apple, because they can deliver big wins, life-changing wins, but only if you let the gains compound year after year. You shouldn't touch the stock unless something goes severely wrong. That's the way to go. If you still have the itch to trade, you be my guest. Just know that it's usually a loser's game unless you're doing it as a full-time job or you can hire lots of traders to do it for you. Most people can't do that. So I say, you know what? It's just not worth even trying. I like to say there's always a bull market somewhere, and I promise you I'll find just for you right here on Mad Money. I'm Jim Cramer, and I will see you Monday.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.